Welcome to Making the Grade, the podcast that explores what's driving the decline in graduation rates between funding rounds and what it really takes to scale a venture-backed software startup successfully with realistic options to exit. I'm Tom Glasson, CEO at Scalewise, and each week I'm going to be joined by founders, investors, and some of the best go-to-market leaders in the world to unpack the strategies, the missteps, and the mindset shifts that separate those who graduate from those who don't. Expect real talk, actionable go-to-market insights, and honest stories that will help you scale more wisely and thrive in an increasingly competitive market. Because there is a smarter way to scale, and we're here to uncover it. So far in season 2, we've heard from revenue leaders, founders, and CEOs, but today I'm joined by an investor. Hillel Zidel is the managing director of Kennet Partners, a growth equity investor with $1.4 billion in cumulative funds under management. Hillel invests in founder-led, capital-efficient B2B SaaS companies that are navigating the critical journey from roughly 2 million to 10 million in ARR, the stage where growth either compounds or quietly stalls. In our conversation, we dig into what really separates the companies that break through from those that get stuck, how investor expectations have shifted, and why founders' ability to take input may be the biggest determinant of long-term success. If you're a founder or revenue leader navigating the 1 to 10 million journey, this episode is packed with clear, experience-backed insights you'll be able to apply straight away. Really pleased you could join us today, Hillel. It's great to have you on. How are you today?
Yeah, fantastic. All good. How are you doing?
I'm really well, thanks. Yeah, really well. So Hillel, there's so much I want to talk to you about. But I think where we'll start is, as I said, that 2 to 10 million plus journey. I've personally lived that journey a few times as a CRO. It's always felt like the point where companies move from kind of early traction into real complexity, not just more growth, but more decisions, more risk, often more trade-offs. What is it about that 2 to 10 million plus journey that makes this stage so compelling for you and Kennet?
I'd say we start investing in businesses at about the $3 million ARR level. And we like that stage because we generally believe that they've demonstrated some element of scale. So you've probably got a bunch of customers, you've probably had some renewals, you've started to build the bones of a team, and our view is that at this point you can start to determine whether there's product market fit or not. And so I'd say we start, our entry level is between 3 and maybe 7 or 8 on entry. And so I think the key things that start to change once you move from 3, to 7 to 10, at 2, 3, 4 million, really the founder CEO can control a lot, right? They're often, focused on a whole bunch of areas. You typically have a co-founder who's doing product technology, CS, and it's a pretty constrained organization in the sense that, a small number of leaders can have visibility of everything. They've typically hired from their networks and demonstrated that, that level of traction. I think as you start to, scale up, there's more complexity, clearly. And I think one of the, probably the toughest transition, for founder CEO is the point where they're bringing on, senior experienced hires at the VP level, and they now need to cede control of those areas. I think typically at about 10 million, that's the point at which you really, if you want to maximize and scale, you should be bringing on board, highly experienced operators, have done it before and who are going to run those areas clearly under your guidance, but you're starting to see control, to other leaders. I think that's one of the probably the key change that a founder experiences.
Yeah, and no doubt we'll dive into that founder transition and the mindset and the hires that are needed shortly as well. But one of the things we're obsessed with on this show and at Scalewise more broadly is this concept of graduation rates. Why some companies push through, that 2, 3 million ARR, but others kind of hover at, that stage and maybe struggle to really break through to 10 million plus. From your vantage point, and given all of the businesses that you've seen, what really separates the companies that break through to 10 million plus from those that kind of get stuck at like 2 to 5 or 2 to 6 million? What really separates them?
So I think there's a couple of things, and I think some of these are within a company and a founder's control, and some of them are not. I think we've done a lot of work on trying to predict how companies are going to perform based on we've done a whole lot of deals over 6 funds. We've had a lot of exits, and so there's a lot of data to analyze. And I think a few of the key sort of points that we think predict that a company is going to scale. The first one is how established the go-to-market is. So, you can be at $3 million in ARR, but if you've got 3 or 4 salespeople who are starting to predictably generate and convert quota, and now we're going to invest and we're going to put 15 or $20 million on the balance sheet. A significant part of that is to hire more sales and marketing folks. The extent to which there is somewhat of an established, developed, not necessarily predictable, if you can start to predict that, that's a key indicator of your ability to scale. I think the opposite of that is pure founder-led sales, right? So when you're at pure founder-led sales and the strategy is to move to an outbound go-to-market. Now, we've done that and that has worked, but your kind of, to use your terminology, the graduation rate is low, right? Because the customers who go out and find you are not easy to sort of build a sales force and go and find those customers. So we have a whole bunch of strategies to do that transition from inbound to outbound, but the extent to which there is somewhat of an established existing go-to-market is a strong predictor that the company is going to scale. The second one is the level of experience of the team. So if you have a founder CEO who's done it before, for example, in any area, right? Doesn't need to be in tech even, but has gone through and built a business, that's a strong predictor that the company is going to scale. Now, not every founder has done that. And, we back first-time founders, we back, serial founders. But I think when it's a founder who hasn't got that experience, again, a prediction for us is who are the folks surrounding that founder? So do they have, or can we bring, for example, build a board, advisory board, or bring on board non-exec operators who've done it before? Can we introduce go-to-market folks who, again, have done it before? Because I think we just don't want a huge amount of learning on the job around scaling. And so we're very happy to come on board and back a great first-time founder, but we really like them to start to surround themselves with folks, particularly on the GM side, that have already done it before. Number of customers, you can be at 10 million and have 5 customers. That's, it's hard to say, okay, so cadence of adding customers. And I mean, I'd say we want to see at least like 20 customers. I mean, maybe a bit less, but if there's sort of 7 customers, that's much more VC than we're really, really comfortable with. I'd say the other key predictor of scale is new logo acquisition. So, you can see businesses that have really strong financial profiles where a lot of it is coming from upsell. 80% is coming from upsell. These look like great businesses. What we found is 18 months later, those are less likely to have scaled than those that are really driving new logo acquisition aggressively. In our own track record, there's multiple examples of folks not having any of those and scaling. But just going through the data of all the deals which we've done recently, that's the conclusion. Those are the predictors for us.
Yeah, you make such good points there, Hillel. I'd love to just drill into, well, I suppose, a couple of them. One bottleneck we see again and again at this kind of 2 to 10 million stage is pipeline. Inbound starts to flatten, revenue targets go up. Suddenly demand generation becomes the kind of limiting factor on their growth. And what often tends to happen next is that teams then do default to outbound. They hire SDRs, maybe a VP or a CRO. They assume that kind of, headcount, capacity is going to solve the problem. But especially over the last couple of years, I've seen a lot of companies really struggle to get a predictable outbound engine working. Why is the shift, in your view, from inbound led to outbound such a dangerous moment for capital efficient businesses?
One of the things that we see is that level of organic kind of inbound that you're getting at 3-4 million in ARR is great at that scale, but you tend to get the same amount of organic inbound 2-3 years later. right? It's very hard to scale that. And then, so the question is, well, how do we go outbound now? And yeah, there's always this temptation, to bring on board kind of what we think of as like the shiny shoe CRO, talks a fantastic game, has a great record in a very different organization, and is going to, go out and hire a whole lot of sales reps and pods and build everything. We're going to, deploy kind of $10 million. I mean, that model is very tough, right? It infrequently works. And I think one of the key things is a big part of this is, the founding team are able to, when they're very close to deals, they can, do the kind of convincing and selling. And then you hire someone who's very disconnected from the business, has their own processes, and then, things sort of change. So that's why I say we're much more enthusiastic when there's a little bit of even, just some green shoots of outbound kind of progression. Now, when you don't have that, our approach is incremental, right? So what incremental means is we're going to start to expand internally. We're going to start hiring at a small scale. We're going to course correct the kind of, sales folks we think are working. And then we're going to start to build a predictable model. And, the obvious trade-off is you're not going to grow as quickly, right? As if you hire, 20 salespeople and it works straight away. But the probability of that happening is actually pretty low. So what you want to do is you want to start to build that out. And then maybe 12, 18 months into the journey, it's like, all right, now we understand how we can be effective outbound. And now we can bring on board some of those kind of, kind of CROs to really build more aggressive outbound. But I mean, the movie that we've seen a lot, and I'm sure many other investors have seen, is companies doing well, raise a bunch of money, go out, hire a ton of salespeople. They don't kind of, perform at the level you want. And then it's like we ramped the burn up, and now we need to kind of manage that. So I love it when companies kind of spend a bit less in the first year while we're going through this sort of incremental move from inbound to outbound.
Yeah, there's a lot in that that really resonates. What we've seen is that outbound rarely fails because the channel itself is wrong. It fails because the kind of foundations aren't there or properly in place. In particular, SDR teams, without that real strong SDR leadership or coaching, just don't learn fast enough. And often the ICPs are often too broad or loosely defined to really make that outbound work. And I think when outbound does work for our clients, it's usually because they've been brutally focused on that narrow ICP, backed by real data, but also with proper enablement, people that can coach those SDRs and enable them to be successful in role. But at this stage, that 2 to 10 companies are often experimenting across multiple fronts, not just outbound, but also partnerships, new verticals, perhaps new geographies. And it's very easy to, I think, lock in cost before you've really found repeatability. How do you encourage your portfolio companies to experiment, I suppose, without damaging unit economics or burning too much optionality? And you touched on it a little bit there in terms of outbound, but how do you think about those experiments that they should be conducting to find the growth levers that are going to drive the capital efficient growth in particular?
So when we invest, we're typically focused on capital efficient companies or bootstrap companies. So these are businesses that historically have not had a lot of money to spend. And the risk is that you now have $20 million on the balance sheet. That feels like a lot, and it feels like we can kind of do everything, right? And actually, you sort of don't want to do that. I think, yeah, step one is really to preserve what's working. Whatever the mechanism, the motion is that's driving growth today, let's just make sure that we maintain that as kind of a baseline. And then let's understand what the other areas are that we really want to focus on. So it may be, for example, that, you know, 50% is inbound, but actually 15% is coming through partner channels. And we haven't really invested in those partner channels, but we know that there's a bunch of partners who like us or we could distribute through it. And let's start to build on that model. I think you want to do too many things at once. You really want to, spend the time developing the conviction on what is most likely to be successful. And I think the things that are most likely to be successful are the things that you can show some data behind. And you don't need to do everything to be really successful. right? You can just, if you just nail in this example, partnerships, then, that could generate, a good few years of further acceleration. So there's always a temptation to say, well, we've got huge balance sheet now. Let's do these six things. You don't want to do that. I think you really want to take the time to kind of rank order what the options are, which ones you have the highest conviction, and then start to kind of deploy strategies in those areas.
Yeah, that makes a lot of sense. And I know that, often one of those six things that they're looking at doing is US expansion, often a big draw for founders chasing growth to 10 million and beyond. But I've also seen firsthand how a lot of value can be destroyed and cash burned when founders go too early, or maybe they hire too senior, or maybe they underestimate the go to market in the US. I know you've got a lot of experience here, so I'd love to kind of dive into that. When does US expansion genuinely make sense for a capital efficient founder led business?
I guess there's two sides of this. There's the, what makes sense for the company. What do we look for? What do we want to see? So, for us, the things that excite us and get us comfortable about a US expansion. So, I mean, the most obvious one is we've already got a bunch of US customers. And usually those US customers have found us, because we have cool solution that's kind of unique in some way. And now X, I mean, 25% of net new ARR, for example, is coming from the US. There's some product market fit in the US. There's a bunch of customers that are using the product, and we want to build upon that. On the contrary, if we're looking at a company that has like no US sales, but it is very excited about the US, we may well back them to do that. But from an investment return perspective, we won't bake success in the US into our return. We'll say, okay, for us to get to our return multiple, we need to assume that that they get there in Europe only. So the extent to which before raising capital, you can start to kind of win US logos is really valuable at the point in time when you're in the market and saying, well, yeah, we're raising capital down, by the way, 25, 30, 40% or whatever it is of net new ARR is started to come from the US. And now we want to really kind of build upon that. What we've seen is when you're successful in the US, it's like massively transformational in terms of, the value that's created. When you're not successful in the US, you're set back like 2 years because we have to now unwind all this stuff. We need to revisit all our assumptions and that sort of thing. So the way, from an investment perspective, we try and de-risk this first is, okay, there's a bunch of US customers, who like us, we can reference them and we can build upon that. The second is we do a lot of work on what the US competitive landscape is, what is the reason for this European company, to be successful in the US. And then we deploy somewhat of a playbook model. The playbook model, I'd say, well, a key component of that is ideally the founder CEO is moving to the US or is spending a lot of time in the US. One of the founders is kind of going there. Again, I'd say a key predictor of success in the US, assuming that we've got some US customers, is founder commitment to that market. Because all that hard work that the founder did in the early days to get customers excited about the product doesn't really translate that easily when you move into a new market. You kind of need to do that again. Yeah, you got more to build on and there's more of a product and that, but getting a founder to have spent a lot of time there, we think is really fundamental in terms of getting success from the US. The thing that doesn't work as well is with a US salesperson who's not going to build out the US channel. I mean, US salespeople by definition are great at selling themselves. So everyone looks fantastic, but it's very hard to translate that. So you want the founder to be spending time there. We want to send some of our local folks, start to scrape the bones of that office. And again, once we're seeing we got traction, the opportunities building. Now let's really deploy very aggressively to massively expand that. But I think, what may be coming out is, we want to like really focus on the stuff that is working very aggressively, but we don't want to be very aggressive until we know what's working.
There's so much sense in everything you've said there, Hillel. And I speak from experience knowing that, just hiring someone out in the US, a senior sales leader, and not having a CEO or founder or some of those key employees from HQ over there supporting can definitely make things very, very difficult. But I still see founders time and time again when they're thinking about US expansion, thinking, right, we're going to hire a VP sales in the US and we're going to build around that person and we're going to get them to build a team. What advice would you give to those people, those founders that are thinking about taking that step right now, versus the founder moving out, versus taking maybe a sales leader from the UK and moving them out? And maybe if you've got any stories to share around where that hasn't worked, hiring that expensive VP sales, like what advice would you give to that founder that's maybe about to push the button on hiring that expensive VP sales out there?
So that wouldn't be our approach. But if that was the approach the company wanted to take, I think what I sort of think about is kind of risk mitigants, right? Like how do we manage this? Now, clearly you've got a plan for success and we want this, to be successful. I think the first thing is you need to be involved. You need to work closely with that individual. The issue comes is where sort of they're building a fortress, kingdom, whatever in that market. And it's like, trust me, it's all going to kind of work out. This is at the early stage. So yeah, I think getting, very regular cadence reports of how things are developing and inputting, I think is important. I think the second thing is really constraining the spend, right? So it's one thing to unwind US CRO. I mean, it's another thing to unwind a team of 15 people in the US. So, and all circumstances, I'd say I want to do this incrementally. I don't want to have, you know, hire a whole bunch of salespeople immediately and hope that works. I think I would definitely have, as I said, a board member, yeah, or an investor or whoever it is who's been through this journey, who's inputting and supporting with that individual. Our model is we want to be successful in all of our investments. We want our founders to make money in all deals that we do. We don't have a VC model where you're really going for one company that's going to return, 3x the fund or whatever, and you're happy to tolerate a lot of failures. Because if that's your model, then you might as well go big on every single deal because one of them may work, right? But if you are a founder, 1 in 10 may not be what you want to do with your audio recording well. So that's why we have this approach. We're optimizing for success across the whole portfolio, as opposed to saying, all right, we're going to take 10 huge bets and we feel pretty comfortable that one of them, will work. So I think it also depends on what the CEO's mindset is, right? I mean, there are many founders, who want to be extremely aggressive, have a really high risk tolerance, and are kind of comfortable that this may not work, probably won't work, but they kind of want to go for it. I think the key is understanding what your odds are, right? And where we tend to see the super aggressive model is where the founders have already raised a lot of capital. So you have a $50 million or $100 million pref stack. And so, incremental growth doesn't make sense, right? You have to get $1 billion, exit in order to make any money. That's not what we're doing, right? We're working with founders who they own 70% of the company, right? They have all their net worth in this business. They've been building it over 3, 4, 5, 6 years. The idea of losing it all is not super attractive to them. So they say, well, we're not going to go for 50x return. We like the idea of a 3, 5, 7x return. And we're going to do that in a somewhat more careful way rather than kind of going, full on and you're hiring and spending it all kind of, very quickly.
Makes so much sense. You mentioned earlier in the conversation something about shiny shoes, VPs of sales. Tell me more about what you mean by that and what are some of the risks and implications of having shiny shoes?
For me, it's an individual who presents extremely well. So, they're really well polished. They're really well presented. They have a CV which reads really well, typically in big companies. And they sort of talk to us in a way which gets particularly European founders feeling like this person knows everything. They've done it before. They kind of get us. And the challenge is a lot of assumptions are made in that. So the assumptions are they understand sales in our business, right? They understand product generation, and the challenge is that operator is usually good when things are working really well, and it's probably 15 million, 10 kind of plus. But When we're at 3 million, there's just a lot there's a lot of kind of gritty friction stuff that needs to be understood before that individual can be successful. And I think that's kind of the disconnect. Not to say, you shouldn't shine your shoes or any of that, but it's just in my mind, it's like it's a perfectly polished picture, but that individual is probably the right person for us in 24 months' time, but not today when we're trying to figure all this stuff out.
Yeah. It sounds like that classic leader stage fit issue, which get made so many times, that mistake. And as you say, it is about those very well polished candidates that are really good for a later stage, but not this scrappy early stage. And those hires invariably go wrong. They've left the business within 12 months and cost a lot of money in the process. But there is so much conflicting advice, I think, on kind of when to hire that senior sales leader. People seem to go for the CRO role, I think, like quite quickly, and they think that's going to be the silver bullet. I've seen, decisions go both brilliantly and also terribly wrong. In your ideal world, how should a go-to-market organization evolve on that 3 to 10 million journey? When does it actually make sense to bring in a senior sales leader?
If this was easy and straightforward, every single deal would be successful. And so there's lots of ways to make this work, right? So I wouldn't, say that this is the only way, to kind of make things work. As I say, we've seen it, including our own portfolio work in lots of different ways. So maybe if I give a couple of examples on how things are going in these cases. I mean, we have one company which we invested around about 5 or 6 million when we invested. They had about maybe more than half their customers in the US who had all found an inbound. And what we've done in that case is we've hired a very experienced this is it's a category where everyone sort of knows each other and it's very specific. In that case, they started off by hiring a European VP of sales to run global sales. And they took a couple of their highest performing SDRs in Europe and moved them into the US and have started to hire US folks directly to expand and scale out in the market. And the company's doing really well, right? I mean, I think, things are going well. I think, over time, as, they win more and more US logos, this, needs to migrate more to be US based. I think you're at a point where you could do that today, right? Because they were getting good inbound. They've done this conversion to kind of outbound. They're demonstrating very good logo acquisition in the US. You're at a point now where you can really kind of place all your chips on the US, on the US market. But it was done in quite a risk mitigated approach by hiring kind of someone they knew and trusted in Europe. Now, this person had operated in the US and sold in the US, and was that sort of he wasn't, he had experience in that market, and that the founders were comfortable and has worked pretty well. I think in other cases, the company started to find that the pipeline in the US, I mean, what typically happens is US pipeline is growing, and these are huge opportunities, much bigger than the European opportunities. And once you have that to say, okay, now we're going to bring on board that US VP of sales to really build on what we've kind of done in the European market. Yeah, I think it just comes down to having conviction that we've got product market fit in the US, and we've demonstrated that we can do some outbound stuff, and we're going to transport this into a new professional hire. It kind of depends, but I guess the time not to do it is when you do not know what to do in the US and you want to hire someone to solve all your problems. But like, that's the time not to do it. You want to do it when it's kind of working and we want to get more of it, as opposed to like, we just don't know it. And this person is going to solve all of our problems.
Such good advice. So just shifting gears a little bit then, Hillel, we're in a really interesting moment right now. On the one end of the spectrum, you've got a cohort of AI native companies raising huge rounds on enormous expectations and valuations. On the other, you've got a much larger group of SaaS and tech businesses that I suppose suddenly find themselves being judged against maybe a different bar on efficiency, on durability, quality of growth. what I'm seeing is that the definition of good or marketable businesses has shifted quite materially over the last couple of years, especially in the shadow of this kind of AI hype cycle. From your perspective as an investor, what does a genuinely marketable business look like today in terms of metrics, capital efficiency, and overall profile, particularly for companies that aren't in that AI native unicorn space?
I mean, I think there's a few things. I think the first thing is growth expectations, I think, have come down. So if you look at, public market SaaS companies, median growth 24 months ago across the market was 30%. That dropped to like 15%, hovered around there for a while. It's now sort of 16, 17%. I mean, public market valuations have come down also. So, the kind of valuations that you would have achieved in the private markets relative to, where things were 24 months ago have also kind of come down. But along with that, the growth expectations are a bit lower. Growth is sort of more acceptable, let's say. So, but you ideally, in order to, attract capital, you want to be north of 30%. I think that is still, kind of a key point. I think you can be a little bit below that. But if you're at 10%, it's really tough. The second thing, which is a lot of focus on, and it's something we've always focused on, kind of rule of 40 and efficiency. So, I mean, I've heard of PE funds talk about rule of 60, but they want to, it's like want to really be super, super efficient. But I think you should ideally be at rule of 40 or close to it, and more in the growth than in the profitability. So if you're 30% growth, 10% profitable, that's more attractive than 10% growth, 30% profitability. But the world of not looking at cash burn, bottom line efficiency, other than in native AI, is not a world that we're in at the moment. I'd say that's that's very key. The third thing is a strategy around AI. Step one is like, okay, we're not going to be railroaded by new initiatives in AI that just kind of to completely kill our business. Step two is we've got an AI roadmap, which we're excited about, and we've started to deploy, and we're seeing some kind of wins within that. I think without an AI roadmap, it's very hard to attract capital. You really need that. So I'd say at a core level, those three things are really fundamental. It's like reasonable growth, reasonable efficiency through Rule of 40, AI roadmap. And then, I'd say following on from that is, I mean, this is for us, right? People have different folks, but, the stuff we talked about earlier. So the new logo acquisition is starting to form an established go-to-market model. And I think actually, so one of the things probably comes earlier than that is retention. I'd say the focus on retention is just really, really strong now. And that's a counterbalance to an acceptance of lower growth than we had. So, a way to look at this is like, I understand you're not going to grow at 80%, probably going to grow at 30 or 40%, but I want to know for sure that you're going to retain the customers that, that you're growing. And I think the drop from acceptable gross and net retention rates to weak, it's a cliff in terms of valuation, in terms of attractiveness. And so, we spend a lot of times with our companies really focusing on getting, retention to good levels.
Great points. Yeah, really good. And I suppose just staying on the theme of AI, Hillel, you've written really thoughtfully about AI and education. I read a beautiful post of yours, and not just as an investor, but as a parent. How has AI changed your view of the skills that you know founders, leaders, but also the next generation, our kids, will actually need?
Yeah. So, I mean, I like you, I look at this from a kind of a business level, and I'm excited, and we're deploying a lot of capital into, AI initiatives. And then, you sort of look at it from, you know, young people now, and how AI is changing the world for them now, and how that's likely to change things kind of in the future. I mean, I think, the things that I feel have become much more important. I mean, they've always been very important, but other things, that other stuff which AI can do easily now is frankly less important. So, I mean, I think creativity is really fundamental. Today, what a lot of AI does is it looks at the historic stuff, and it creates outputs based on what's happening in the past. Whereas, as human beings, what we can do is create totally new initiatives, right? Totally new products. And I think that's something that folks in every, it's not in business, in like education, life, and everything. I think real focus on creativity is important because I think that AI can do a lot of the generic kind of stuff. The second one, which again, is not to say this has never been, and this has always been fundamentally important, but I think is much more important now is judgment. So, there was a lot of value, historically, a lot of value in collecting the data, analyzing the data, getting some, outputs and analysis, whatever. All of that is like kind of largely commoditized, right? So deeply understanding how to make decisions based on data, which we now get easier, conclusions from, I think is really, is a key sort of, vector for value. I think the other thing, that's really important is integrity. I mean, again, this is like always been important, but I mean, what I'm sort of saying is I think schools should teach all of this stuff. It's not, they shouldn't kind of get as a byproduct of what people learn. I think your schools should be teaching creativity, should be teaching, judgment, and should be teaching integrity because there's just lots of ways AI stuff can go, right? And I think you really want to bound it within, a few kind of key, key areas. So, I mean, clearly there's lots of opportunities, but there's also lots of ways things can go sort of, negatively. And I think you want to really be focusing on that.
So to wrap up the show, we'd like to ask all guests this one final question because at Scalewise, we're obsessed with helping companies improve their chances of going between Series A and B or 2 to 10 million as a proxy for that. From everything you've seen, what's the single most thing that you think improves a company's chances of successfully making that leap from 2 to 10 million and plus?
I think there are a lot of factors, but if I were forced to give one bit that I think it has the most impact, it is the ability of the founder to take input, the ability of a founder to surround themselves with folks who've been through the scaling journey and decide what inputs they want to take and not take, but really be coachable in a way where they're able to say, okay, Dave has done this, Sharon has done this, they've given me this sort of input, and you don't need to listen to both of them or either of them, but you need to basically be able to shift your perspective in order to learn from the experience of folks that have done this before. I think that's kind of the key thing that I would say determines, success. And I would say this is like not just for fans, like for anyone, right? For anyone trying to build something, being able to take external inputs and re-underwrite your own thesis against those. You may disagree with it, it's fine, but just the ability to do that in your kind of advancement for success, I think is probably the key factor that will determine that kind of leap.
That's a great way to end. And Hillel, this has been an incredible conversation. You've shared, I think, a rare combination of strategic perspective and just very practical pattern recognition. And I know this is going to resonate deeply with founders and go-to-market leaders who are right in the middle of that 2 to 10 journey, but also to parents who are navigating the future of AI with their kids as well. I really appreciate you taking the time and being so open with your insights. So thanks again for joining us on Making the Grade.
Yeah, my pleasure. It's been really, really fun, and I hope folks find it useful.
Amazing. Thank you so much for listening to Making the Grade. We really hope you enjoyed today's episode. If you have any questions following this episode, or you'd like to recommend a guest perhaps for our next season, please let us know at podcast@scalewise.com. And if you did enjoy today's episode, please do consider leaving us a review on either Apple Podcasts or Spotify. We'd really appreciate that. As this is a brand new show, reviews really help us spread the word and reach new listeners. Plus, we'd also love to hear what you're enjoying about our show. Thank you so much for your support, and see you soon for another episode of Making the Grade.